Welcome back to the 12 Charts of Christmas. Let's end today with perhaps the central question facing world markets at the moment, which is that the US stock market and the US bond market are telling us completely different things. As you can see, the red line there is the S&P, a quite remarkable story of uninterrupted growth for over 3 years now without a 10% correction, obviously suggesting deep optimism about the economy. Meanwhile, the blue line there, the bond yield, suggests over the last year increasing concerns about contraction, that there isn't much growth coming. How can we reconcile these? Now, equity bulls can always say, well, lower rates mean higher profit margins, they justify higher multiples, so maybe that could help. But it's very hard to avoid the impression that those jaws are going to close either when the Fed decides it's not going to raise in 2015 after all, and people begin to grasp the negative implications that has for growth, so stocks begin to come down, or when bond yields finally begin to rise, either because of the Fed or because somehow or other inflation actually starts off again, and again you see those jaws begin to tighten as rates rise. So it's very much harder for the stock market to keep rising. For the time being, we have this very strange example of Goldilocks. You could almost call it Goldilocks on ice. Not so much not too hot, not too cold, as very cold, but not so cold that hell freezes over. Just cold enough to keep the Fed going.
Sorry to stop you. Shall we do this again? There was some distortion as well in the mic, and there was
I was using my hands too much. Okay, ready? Ready?
Yeah, still running.
3, 2, 1, go. Welcome back to the 12 Charts of Christmas. Today I'm going to take a look at perhaps the central imponderable question of world markets, which is that the US bond market and the US equity market don't agree with each other. As you can see from this chart, the S&P 500, the main index of the stock market, has had a remarkable period of uninterrupted growth for the last 3 or 4 years, more than 3 years without a 10% correction, showing great optimism about the economy. Meanwhile, however, bond yields remain remarkably low, and they have actually fallen over the last year, normally suggesting great concerns about the economy, suggesting that things are very sluggish, that there is a risk of deflation. How can we reconcile these? Well, equity bulls would say lower bond yields mean higher profit margins, justify higher multiples on stocks. But you can only take that so far. The risk has to be either that the Fed passes on raising rates in 2015 because it becomes obvious that the bond market has been right all along, that there isn't any growth coming, in which case stocks will come down, or that those rates will actually start to rise at last, maybe even because of inflation, because there is genuine growth coming, or because the Fed tightens more than it should. Either way, that would then again bring the stock market down. Either way, it's hard to reconcile what these two critically important, very liquid markets are telling us, other than that there is a risk that the stock market is too high. All will be revealed during 2015. Have a good new year.